described long lines forming at petrol stations amid supply fears, at the same time as EV displays were pulling the biggest crowds at the Bangkok Motor Show. In order for all of this data center build to actually be useful to the domestic economy, we have to generate enough demand for compute that we are creating startups. We are creating the activity that benefits from the infrastructure that is there. It is not that Asia has no money. It is that the money is choosing other places to go. It's choosing India's depth. It's choosing Japan's stability over Southeast Asia's fragmentation and its weak record of performance within the venture capital asset class. Hello and welcome back to the Sea of Startups. I am your host, Kevin Brockland, managing partner of Indelible Ventures. And this time around, we're going to be talking about one shock with three different faces. The same spike in the oil price that pushed people into electric cars also raised the price of the power the data centers are now hoarding, and it handed every cautious LP a fresh excuse to keep their money in the drawer. Energy, iron, and idle capital. Follow the power, and you followed the whole regional story. So I want to kick this off somewhere that has nothing to do with startups, really. It's the Strait of Hormuz. Now, I'm not going to dig into the politics. I'm not an expert. I'm not going to dig into any of that. But if you have never thought about it, here's why you should. It is a sliver of water between Iran and Oman, and on a normal day, roughly a fifth of the world's oil moves through it. Background, everyone knows what ended up happening, and price of oil did as you would expect. Brent jumped 10 to 13% in a single session to the low 80s, and then just kept on climbing and climbing and climbing, which is essentially the highest since 2022. International Energy Agency, which does not deal in drama, called it the largest supply disruption in the history of the global oil market. Now, hold that thought, because here is where it gets interesting for us in Southeast Asia. When the price of petrol becomes a headline instead of a footnote, people change what they buy. And one industry in this region was standing in exactly the right place when the oil hit the fan. That was electric vehicles. Now, I want to be careful here because the lazy version of this story is war happened, everybody bought an EV. That is not what happened. And Tesla is barely in this fight out here in Southeast Asia. What happened is that a fuel shock landed on top of a shift that was already fast moving, and it poured petrol, pun intended, on the fire. The scale first. In 2025, EV sales in Southeast Asia more than doubled year on year to more than 500,000 vehicles. The IEA flagged this region as one of the largest increases in EV deployment anywhere on the planet. More than 90% of those were full battery electric, not hybrids. So demand was already there. Then, in early 2026, the gas station queues showed up. A Thai market report described long lines forming at petrol stations amid supply fears, at the same time as EV displays were pulling the biggest crowds at the Bangkok Motor Show. Is the whole story in one image. One queue for the old thing, one crowd for the new one. Let me go around the region because the averages hide the real story. So Vietnam is the outlier nobody outside of Asia really talks about. EV share of new car sales hit close to 40% in 2025, ahead of the UK and the EU that is almost entirely one company, VinFast, which owns something like, I think it's at like 99%, basically the entirety of the domestic EV segment. And it took nearly 40% of the entire car market in the first quarter of 2026. They delivered 175,000 EVs in 2025, and they're targeting 300,000 in this year, at least according to the last report that I was able to research. First quarter deliveries were up 61% year on year. And yes, local press noticed the timing. One outlet ran the headline as gas prices skyrocket will VinFast's electric vehicles profit. And that was in the Nikkei Asia, as well as a few other publications as well. Quite subtle, right? Let's go to Thailand. Thailand is the one to watch for the fuel link because it is the most direct. EV sales tripled year on year to over 44,000 units in January 2026 alone. A record month, and analysts tied it explicitly to volatile oil prices, pushing people off petrol. Full year 2025 was already 120,000 battery EVs, up 80%, or about 19% share. The commercial side is the tell. Logistics operators are switching to electric specifically to cut their exposure to fuel cost swings. When the fleet guys move, it is about the spreadsheet, not the planet. Now, over to Indonesia, which crossed, I think, 15% EV share in 2025, passing the United States for the first time. The interesting part is who is winning. Chinese brands took more than 75% of the Indonesian EV sales, and BYD nearly doubled its volume into early 2026. This is not a Western EV story. It is a Chinese supply story with a Southeast Asian buyer. Now, coming over to Malaysia, we have a similar story. My home market, where I'm based at, it's earlier. EV adoption has jumped roughly 14-fold since 2022, from just a few hundred units to about almost 45,000 in 2025. But that is still only about 5.5% of total vehicles sold. And here's the honest caveat for Malaysia: we had about 5,000 plus public charge points at the end of 2025, short of the target. You cannot fuel shock your way past missing infrastructure, which is the hindrance of Malaysia keeping pace with the growth. Now, Philippines, where I spend a lot of my attention and I spend a lot of my time these days, is the most interesting policy move of all, and I come to it next. So let's dig into that, because none of this is just consumers being noble. It is policy and cheap money combined with the specifics of the opportunity. So Thailand cut its excise tax on passenger battery EVs from 8% down to 2% since January, and to zero on electric pickups, on top of a 50,000 baht subsidy for locally assembled models. That is a government deliberately trying to encourage the adoption and purchase of electric vehicles. Philippines went further, and the framing matters because Manila is putting forward an EV incentive package worth about 60 billion pesos, and critically ending subsidies for combustion engines. And the reporting is tied that move directly to the global oil shock. Now, read that again. A government using an oil crisis as cover to stop subsidizing petrol and start subsidizing electrons. That is the kind of capital and policy shift that actually changes how a market can end up getting built for electric vehicles, and how they can actually use policy and incentives to encourage that shift. Then the banks. This is the quiet part. In Singapore, UOB ran a green car loan at 1.5%, DBS at 2.4%. Toyota's finance arm is piloting green financing for EVs in Malaysia and Singapore. And when bank prices your electric car loan below your petrol car loan, the moral argument is over. It starts becoming more of a maths decision in regards to the opportunity cost and the cost comparison. And every consumer likes a discount, no matter the size of the purchase, especially if you're talking about something that's in the tens of thousands, depending upon the currency that you're talking about. Now, the part that ties straight back to the startups and operators the show is actually about Grab. Last year, Grab signed a partnership with BYD to put up to 50,000 EVs into its fleet across all major Southeast Asia hubs. In Singapore and Thailand, they added eco-friendly rides. So if you toggle while you're trying to search, you can find that. Get a green vehicle, no surcharge. In Indonesia, they have been rolling BYDs into the fleet in the thousands. When fuel is the single biggest variable cost for a driver, electrifying the fleet is now an environmental story. It's also a more margin story. A driver on EV during an oil spike is a driver who keeps more of every fare. Assuming assuming wherever you're plugging in and recharging is not also jumping at the same time. So GoTo took the other lane. Literally, Gojek is going after two-wheelers, committing to convert its entire fleet to electric motorcycles by 2030. So they're also going in that direction, just two wheels instead of four. Now, on autonomous, because I know someone will end up asking, and be honest with yourselves, the Southeast Asia move right now is electrification, not autonomy. We'll see some pilots happening primarily in Singapore where it's more viable, but autonomous vehicle experimentation requires a little bit more of a rule-abiding location where people aren't jaywalking or running across moving in front of moving cars, or some of the crazy driving that can happen in Manila or KL or the traffic of Bangkok or all of this. So it's definitely more, the robotaxi headlines are a US and China story, not really Southeast Asia. So out here, the immediate fundable shift is the powertrain under the existing driver, not removing the driver. If you're a founder pitching autonomous ride hailing for Southeast Asia this year, the oil shock is not really going to help you. The EV fleet swap is happening. So here is where I land, and it's not that really the clean version. The war did not invent the Southeast Asia EV boom. I'm sure if you're around any of these cities out here, you've probably seen it, and you've seen some of the companies actually doing incentive programs, and that has actually been happening for a while. But it didn't start with the conflict. China really has been making an aggressive move with cheap, good cars and a supply chain nobody here can really match. And the governments did with subsidies and tax cuts written before anyone fired a missile. And what the oil shock did was compress years of slow behavior change into a few quarters. So it was started before, it accelerated as a result. It turned a rational long-term switch into a more urgent one. And that is the risk to watch. Demand pulled forward by a price spike can snap back when the price settles. If the Hormuz reopens and Brent drifts back down to the 80s or 60s, some of this 2026 surge was borrowed from 2027 and 2028, being pulled forward. The companies that survive that are the ones building real local supply, financing, and charging, not the ones just riding the fear premium. The oil went up. The smart money in this region was already going electric. The only question that matters now is who built something real while the queues were long. Um, so we have talked. Let's move into our next conversation, which is shifting gears rather substantially. Now, we have talked about Malaysian data center build on this show before, so I'm not going to reread the brochure. Johor is booming. Everyone knows. What I want to do today is follow the money one step further than the headlines do, because that is where the story for founders sits in my mind. And start with the number. Across the region, announced data center capex now runs past $20 billion over 2024 to 2028 window. That's committed, not deployed, because it's future forecast commitments. You have AWS putting $9 billion into Singapore, Google $5 billion into Singapore, plus $2 billion for its first Malaysia site. Microsoft, I think $2+ billion into Malaysia and another 1.7 in Indonesia. Maybe those numbers are a little bit off here and there because it's a little bit of a moving target, but lots of commitments. On top of that, you have private infrastructure money. Air Trunk alone is putting 12 billion ringgit into 2 new Johor campuses, taking its total Malaysian commitment to about 27 billion ringgit. That translates to something like $7 billion now total. And Johor's live capacity has grown basically like 50% in a single year. Now, the question nobody asks is, what is that money actually buying? And here's the I guess, slightly uncomfortable answer, if we want to call it that. It's basically buying land, concrete, power infrastructure, cooling, and imported chips. That is the spend. A hyperscale data center is a real estate and energy project, wearing an AI t-shirt. It's necessary, don't get me wrong, but the single biggest check inside it goes to NVIDIA, to the power and cooling kit, much of it imported. Very little of that 20 billion plus whatever touches a local software founder per se. This is not venture capital landing in the region. It's construction capital. It's infrastructure. This is the digital infrastructure that we do need. But so what is the secondary effect on people this show is about? Now, there's three things, and I want to be balanced here. So one, the cost side, which is real. These facilities pull on the same grid and the same water that local businesses use. I've talked about that in the past. Malaysia has been clear that the grid and water approvals can take well over a year, and the country stopped approving non-AI data center proposals back in 24 to keep the power on AI builds where the future is really driving. And the state is rationing power, and it's choosing hyperscalers over other uses. And when your electricity tariff drifts up in 3 years, this is part of why the public often pays to upgrade the grid that a foreign hyperscaler may end up filling. So no matter which part of the world that you're in, there's pushback on the potential for cost impacts. So one of the things that we've seen in other parts of the world is proposals where those data centers, those hyperscalers, they are basically required in order to reinvest into the energy or water infrastructure environments in those locations as a way in order to offset the potential negative impacts that it could have on the business community around, the residential community around, so that you don't necessarily see increase in tariff rates on energy or water in the surrounding community, even though you have greater demand because you're forcing them to kind of reinvest into that infrastructure. I haven't seen such proposal in Malaysia, but just layering on what has been proposed in other parts of the world. Again, still early days, so I can't necessarily point to success stories and say everybody should be following this model. Maybe somebody can throw out some comments or reach out to me and let me know that. Now, second point is the jobs question. Hyperscale campus employs a lot of people for 18 months of the construction, and then it's basically a skeleton crew to run it. It's not a founder job engine. If anyone's pitching this as employment for local tech population, that in and of itself is not where it is. So third is where the genuine upside actually is. So I do want to give it the due focus. If this build is done right, founders here get two things they did not have before. And that's cheaper, closer compute, which lowers the cost of running AI product out of Kuala Lumpur or Jakarta or Bangkok, instead of renting capacity on the other side of the globe in Virginia or somewhere else. And also, there is local data residency, which is the thing that actually lets a regulated startup, a fintech, a health company, build on sovereign infrastructure without breaking a compliance rule or having to band-aid or stitch together a solution or a workaround that still enables them that elasticity of the hyperscalers infrastructure, but also maintains that compliance. And I think that's part of the actual prize, is the combination of those, not to the data centers itself. It's creating that infrastructure the same way that investing in road infrastructure or power transmission infrastructure, the same way that that is an enabler for commerce, logistics, businesses to operate in different parts of the world to get greater utilization of land across geography. The same way that that infrastructure needs to happen, but is not necessarily the job creation that's goal by itself. It's what comes after. And so my takeaway on this is that the data center boom in and of itself is not a startup story. It's the infrastructure rent story. And most of the rent is collected by foreign operators, to be honest. And a number of the local landlords that are leasing the land for use, the real estate play. And, the only way it becomes a founder story is if the compute ends up and the data residency actually shows up. And if the power does not get so expensive and so rationed that the 8-person team gets crowded out by the hyperscaler next door. So we need to be able to, in order for all of this data center build to actually be useful to the domestic economy, we have to generate enough demand for compute that we are creating startups. We are creating the activity that benefits from the infrastructure that is there. We need to drive the roads. We need to have the trucks transporting goods, to use the analogy to road infrastructure. We need that demand component, which ends up meaning that we need enterprises to start making the switch to digital. We need the government to start making a better switch to digital. And we need a robust segment of startups, AI native startups, creating innovative, creative solutions that are going to be creating the demand for this infrastructure that is now being laid. Because without that, it doesn't end up having the net ROI, in my opinion. So continues to end up booming. We just saw day one raise like 4.5 billion. I think I had said last year, they had the like 2 billion of their last raise, which was I think like 60% of the money that was raised in Southeast Asia. So another example of a lot of money flooding into it, a lot of infrastructure build. CapEx across the globe, across the big tech companies, continues to flow. That's only going to be as good as with any infrastructure of how we actually utilize the roads and take advantage of it. Now, let me transition again to the third topic that I want to touch on, which is because I saw a story about capital being raised and the amount of dry powder relative to the record low deal count. So let me give you two facts that basically set this off, and this will be the wrap up for today, for this session, which is fact one: in the first quarter of 2026, Southeast Asian startups raised about $2.8 billion across 98 equity deals. I talked about that in one of the prior episodes. The same thing if you strip out day one, pretty sure it's China's transition to Singapore data center operator. But if you strip that out, it's a pretty low number in regards to the amount of capital raised, low deal count across the board. Fact two: APAC investors are sitting on roughly $240 billion of dry powder, money committed by LPs that has not been spent. That's down from a peak in 2023 of about 315. But 240 billion is not an empty tank. Now, mind you, like, we're in Southeast Asia, the vast majority of that allocation, one, is late stage capital. Two, a lot of it ends up being overly concentrated into India, into Japan. So the residual Southeast Asia falls into that bucket of APAC, but a lot of that giant number is not really earmarked for Southeast Asia. But so I guess the question is it a drought or is it a hoard? Is it both? And that contradiction is basically the story to touch on here, because here's what's actually happening in my view. The money exists. It's just not moving into Southeast Asian early stage. The last clean read I have on Southeast Asia specific dry powder put it at around $7 billion, which, in all honesty, I think that was well overestimated. Also, that figure is a couple of years old, so I mean it's directional, but the direction is the point. Funding here fell. Essentially 70% since back in 2021. Uh, and while cash pile barely moved because deals just kept on falling, not much new money was raised, but a lot of that money, that dry powder, basically just kind of sat there. Maybe the region's investors went on strike, or they went on an extended holiday, or number of questions there. But now, where did the money go instead? Because there are few funds that are still being raised, just not for most. Peak 15, the old Sequoia India and Southeast Asia team, they closed $1.3 billion late last year. It's the label is India Seed, India Venture, and APAC. India now has more than 250 active. I think that number is actually underestimated. But directionally, they have a lot of micro and early stage funds with average fund sizes from 10 million bucks up to 25, 30. There's a pretty active early set there. India has gone from roughly 9% of APAC capital markets volume to closer to 20. APAC money is concentrating, and it's concentrating into India for growth, Japan for buyouts, and it's not going into Southeast Asia for seed. You're not seeing a lot of it come this direction, except very, very selectively. So when a Singapore-based GP may tell you the market is tough, hear it precisely. It is not that Asia has no money. It is that the money is choosing other places to go. It's choosing India's depth. It's choosing Japan's stability over Southeast Asia's fragmentation and its weak record of performance within the venture capital asset class. Capital is being selective, and Southeast Asia is the one being unselected. And now layer the war on top, because it connects back to where we started this episode. In March, the reporting was blunt. The Iran conflict threatened to deepen what was already Asia's worst private equity fundraising slump in a decade. That was a news story that came out back then. An oil shock does two things to an LP. It spikes uncertainty, and uncertainty is the enemy of writing a new fund commitment or taking a risk position in a new investment. So the same barrel of oil that sold an electric car in Bangkok made a pension fund in the West think twice about backing a new Southeast Asia VC, or it made that high net worth individual in Southeast Asia rethink that new commitment and start preferencing them towards hoarding their own cash. Cash gets more cautious exactly when founders need to be to get braver. And so where I land on this is, do not let anyone sell you the clean drought story, and do not let them sell you the clean capital is abundant story either, because the honest version is this. The tank is full. It's just the driver is scared, and the road out, meaning exits, still looks rough. 98 deals is not a money problem. It's a conviction problem and an exit problem wearing a money problem's clothes. The founder who gets funded in this market are the ones who remove the excuse, real revenue, a real path to an acquire, a reason the cash cannot sit still. And one caveat I have to name, because this show always does, even that 7 billion, if we take it as an actual number, Southeast Asia dry powder figure is fuzzy because so much of it is parked in Singapore holding structures that may deploy from anywhere across the globe. So when the domicile lies, the dry powder number lies a little bit too. But net, the money is here. It's just waiting for a reason. Your job, if you're a founder, if you're a fund manager like myself, it's to be the reason why it stops sitting. I'll leave you on that. Thank you very much for listening in. Like, comment, subscribe. And that does it for this episode of Sea of Startups. If you've enjoyed what you've been listening to, please give it a like, give it a review, subscribe to our channel. A little bit of feedback goes a long way in allowing us to keep on putting out these kind of episodes.